Hi everyone, welcome to my channel. My name is Elmin. I am a CFA charterholder, and in this video I am going to explain the first topic in CFA Level 1 curriculum, Quantitative Methods. We are going to look at the first reading, rates and returns, and the first learning outcome, which is all about interest rates. By the end of the video you will know what an interest rate is, different interpretations of interest rates, and decomposing interest rates to its components. Okay, let's start. In order to understand the significance of interest rates, we need to know about the concept of time value of money. Time value of money basically establishes the equivalence between cash flows received at different dates. As you can see in this diagram, I have put here $1,000 at 3 time points, year 0, year 1, and year 2. Well, time value of money tells us these values are not equivalent. They should not be equivalent. Because if you have $1,000 today, you would not expect it to be $1,000 in a year because there is investment opportunity in the market. Let's say the deposit rate is one of the banks is 10%. It means if you invest that $1,000 in the bank, you will receive $1,100 in the future or in a year. That's why $1,000 received today is not the same as $1,000 received in a year or two. Alright, now I want you to look at the scenarios that we are going to go through from an investor's point of view. Imagine yourself as an investor. You are offered an investment opportunity where you will have to invest $1,000 today and you will receive $1,050 in a year. Well, if you go through with this investment, you're going to earn 5%. That is the first interpretation of interest rate. Required rate of return, which means you require minimum this amount to invest at a certain asset. Secondly, by going through with this investment, you assume that the $1,050 received in a year is equivalent to $1,000 received today, which means you discounted $1,050 to time 0 to this period at 5%. That is the second interpretation of discount rate. Thirdly, if you would not invest $1,000 today and instead consumed it, you would not earn 5%. In that case, 5% is the opportunity cost. Opportunity cost is the cost of not doing something. In this case, it is 5%. Alright, so now we know about time value of money and the three interpretations of interest rate. Now, let's move on to decomposing interest rate to its components. Again, let's continue with the investor example, and you're still an investor and you are faced with different scenarios. Alright, in the first scenario, let's assume there is no risk and no inflation in the economy. By risk, we mean here no default, meaning if you lend $1 to a friend or to a company, you are certain that you are going to receive it back. Inflation means increase in the price of goods and services. When there is no inflation, your money does not maintain its purchasing power. Meaning, if you would buy a kilo of apple for $1 today, you will still be able to buy it for $1 in the future. Alright, in this world, in this setting, you would expect the interest rate, which we denoted as R here, to be equal to real risk-free rate. If we add inflation to this scenario, meaning the price of goods and services are going to increase as time passes, the interest rate is going to be equal to real risk-free rate plus inflation premium. Don't let this premium term to scare you. Premium simply means compensation for a certain risk. If you take a risk, you want to be compensated for that risk. In the third scenario, let's introduce default risk here, meaning risk of not getting your money back. With default risk introduced, our interest rate should reflect that premium as well. So the formula improves to be here, real risk-free rate plus inflation premium plus default premium. Okay, in this fourth scenario, we are going to introduce the term liquidity, which means how quickly you can turn your investment into cash. Let's look at it from the perspective of two assets, gold and a house. Okay, which one do you think you will be able to sell more quickly? Of course, gold. In this case, we say gold is more liquid than a house. And depending on the liquidity of the investment that you are going to go through, you should require a liquidity premium for that. And our formula evolves to be this: real risk-free rate, inflation premium, default premium, and liquidity premium. In final scenario, we are going to introduce the concept of maturity. Well, investment periods are different. You can invest in an asset for a shorter period of time or a longer period of time. And as the maturity increases, there's a more chance for the price of your, or more correctly, the value of your investment to fluctuate, meaning the value of your investment may go up or down, and there is more time for that to happen. That's why we require maturity premium. And with all this concept combined, our formula for the composition of interest rate to its components is complete. And the final formula is here. So the interest rate equals to sum of real risk-free rate, inflation premium, default premium, liquidity premium, and maturity premium. All right. So you will come across the concept of nominal risk-free rate. So what is it? Well, nominal risk-free rate basically is the product of real risk-free rate and inflation premium. This formula here is very important, and you will come across it when doing the problems. So you need to remember it, and you should be able to differentiate the term real risk-free rate and nominal risk-free rate. So basically the formula is here. 1 plus nominal risk-free rate equals 1 plus real risk-free rate times 1 plus inflation premium. You can approximate it like here. So nominal risk-free rate equals real risk-free rate plus inflation premium. All right, that was the first LOS in the rates and returns topic reading. What we have learned is what interest rate means, the interpretation of interest rates, and the composition of interest rate to its components. Please don't forget to like and subscribe. See you on the next video.